Good morning. Let's dive into this session whose title is, as I've indicated on the screen there, amortization, a word very familiarly used in accounting, with the more familiar use being in terms of the interest payments you expect to get per month in a given loan you have taken, maybe it's a mortgage or any other type of loan. So you want to calculate, say, how much will you be paying per month? That is amortization of that loan. So the less familiar way of considering it is in terms of calculating the expense cost of intangible assets over their useful lifespan. I hope you're familiar with depreciation. Similar, but depreciation deals with tangible assets while amortization deals with intangible assets in that sense. So I hope when I press into this, it will actually give you a good explanation of it. The more familiar ways of using the word amortization is in the accounting form of calculating the monthly payments somebody has to make, for instance, for a mortgage loan or for an insurance expense. That's the more familiar use of the word amortization. A less familiar use of the word amortization comes in calculating what I might call the expense of an intangible asset over its lifetime. Let's say, for instance, an intangible asset has a useful lifespan of 5 years and has a cost of, let's say, 10,000 shillings. Now, by dividing 10,000 over the life of that, the expected useful life of this asset, which is 5 years, as I've said, you find out that you have to account 2,000 as an expense per year for that particular asset. This, in effect, makes it possible for you to know that some assets have not an indefinite lifespan, but a fixed lifespan. Like the example I've given you of an intangible asset, say it is a software license that goes up to about 5 years. So by dividing the number of the lifespan over the cost value, you expect to know that at the end of this particular period, if you've been saving enough money as an expense there, then you should be able to acquire a new asset. So actually the whole idea is to make it possible for you to replace the asset at the end of that duration. So this is similar to depreciation, although depreciation now you're talking about tangible assets such as motor vehicles, say buildings. Look at any other tangible asset you can think of. So in the same way, you can actually attach a value of an expense over its expected useful lifespan. So at the end of that period, if the motor vehicle, for instance, and you've been saving enough is in terms of an expense, deducting every month or every year for that matter, then you're able to recover that asset in the future. So both are useful considerations, that is depreciation, amortization, and amortization also in terms of calculating the interest payments monthly for a given particular loan. I give you the example of a mortgage loan or if it's an insurance expense. So it will give you the total value of the loan and then how much will you be paying per month. That is what we call the amortization of that particular loan, the amortization period of the loan. So I hope that is rather helpful. Yes, and that is it. So you can now go further and do more research. You can visit accounting books. You can go to your Google and try to understand the meaning of amortization and try to compare it with depreciation as well.